The Fed's cut rates and Canadian lenders are starting to push each other out of the way to get your business. Yes, all this and more with a good friend and mortgage broker, Mr. Dion Beg. Here we are, my friends, with our favorite mortgage broker in all the land, Mr. Dion Beg. How you doing, my man?
Hey, Gary. I'm good, man. How you doing?
Excellent, excellent, excellent. Listen, my friends, there's been lots going on in the Canadian real estate industry over the last week because just before we went live, if some of you have been playing along last week, the Canadian government or the Bank of Canada and CMHC announced some pretty, I don't want to say drastic, but is it drastic? Changes changes to the way that they see financing. And of course, everyone's scrambling over the last week. We got some pretty animated comments on some of our videos from that, Dion. And there's lots that we're going to kind of unpack from that and kind of the ripple effect and some of the really cool things. And my friends, stay tuned to the end because Dion's going to share with us how lenders are starting to step over each other to get your business. So make sure you stay to the end on that. But my man, where do you want to start today?
Yeah, well, let's start with, let's start with just an example before we go into the stuff that's in the media. I'd just like to talk about an example of a transaction that we're working on with a client right now, because I think it's nice every now and then to just take a look at a case study and see how that might relate to you and your circumstance. So just this week, I came across a couple who we've helped purchase a property in downtown Toronto. It's a freehold property. It's like row housing, but freehold, one of those older style properties. And as always happens with families, they grow. And so right now we've got a young child in the family, but another one on the way. And so obviously when that happens and space starts to get restricted, people say, okay, well, look, what can we do to make this move to a larger property now? So let me just give you the numbers on this property. And by the way, this is in downtown Toronto at Davenport and Dufferin. I'm just going to look at my notes here. And so that property currently it would sell for approximately 1.3 million. Okay, so that would be the sale price. And then after paying off the mortgage and taking care of some other stuff, these people would clear $400,000. So they have $400,000 for down payment on their next purchase. And in our conversation the other day, we looked at two options. One was a $1.5 million purchase would get them the house that they needed. Okay, just a small step up. So 1.5 million. The other would be 1.8 million. But this larger, more expensive property would have a secondary unit in the basement, which they would then rent out. Okay, so let's look at the numbers. Firstly, with a cheaper $1.5 million purchase. Okay, with 400 down, a $1.1 million mortgage, that monthly payment would be approximately $5,775, $57.75 per month. So that was effectively option one. And they knew that that was manageable for them. They could make that work. Then they looked at option two, the more expensive property. And so the purchase price was not 1.5, but 1.8. So that's $300,000 more expensive. But this second property, let me go back to the numbers. 1.8 million, $400,000 down, same down payment. But the mortgage previously would have been 1.1. This year it would be 1.4 million. Okay. And so with this second purchase, the payment would be, of course, higher. The monthly payment wouldn't be $5,700, it'd be $7,400 and change. Okay, so quite a bit more. But once you factor in that basement rental income, and we factored in a very conservative $1,700 a month, knowing that it would be more than that, then that effective monthly payment, once you factor in the rent that they receive from the basement, that effective monthly payment brings them pretty much back to on par at around that $5,700 a month that they would have got on that single family without the basement rental. Okay, so it's interesting, and I know this, and we come across these examples all the time. But the more expensive purchase price leads to an equal monthly payment, or sometimes a lower monthly payment, if you take that rental income into the numbers here. And the interesting thing, Gary, is we project out sort of 10 years, 20 years, and we say, okay, well, given these two options, where the monthly cost is the same. Where will your net worth be in 10 or 20 years in option one versus option two? And in option two, you're hundreds of thousands of dollars wealthier for having chosen a larger asset, which will compound in that market. And it's a matter of a factor of size, right? You've got more exposure to the real estate market, and therefore, all going well, this larger property, more expensive property will compound and result in, depending on the time frame, hundreds of thousands or $1 million plus in extra net worth years from now. So with these numbers in mind, they're pursuing that second option, as you could probably appreciate.
Yeah, I can. And
Yeah.
you know what's interesting is we've talked about this too in the past is, we've both have helped, first time home buyers or you're a step up buyer, just in this case, make that move. And often we're looking at that mortgage helper because of course, typically the areas that I would transact in and maybe like you were that Toronto or that GTA area, or perhaps in Vancouver, that type of thing. But this works everywhere, right? Not just in the high priced cities of Toronto and Vancouver. This will work everywhere. Imagine being in the same situation, Dion, and maybe you're in a Calgary market or an Edmonton market where those prices are somewhat lower than where they are in Toronto and in the GTA in Vancouver. And maybe you're
Yep.
getting 30, 40, 50%, or even more of your mortgage covered every month, right?
Yeah, that has happened. We've seen that over the years. Less so now, given how expensive the mortgage payments are if you're taking on these larger mortgages. But yes, we've seen clients, and actually, in an extreme case, I saw a client choose to move into the basement and rent out the upstairs, the main floor, and be fully covered, right? So cost of living in that scenario ended up being nothing for that person because they were single and they didn't need the larger part of the property, and they just said, you know what, while I'm single and young and willing to live in a basement, I'll do that, right? I also want to mention something, Gary, where, and I've seen this amongst some of my clients as well, where they did start with that upstairs, downstairs, and renting the basement. But as their kids got older and into their 20s, a couple of things happened. The owners, the parents in this scenario, their income increased, so they were able to handle a slightly higher mortgage payment. Also, they might have refinanced and got rid of some other debt, and they vacated the basement so that their adult child could then live in the basement. And I mention this in particular because I've only seen it a couple of times, but I feel like this may be a way in which people can actually house their family, understanding how difficult, pricing is and the ability to qualify is. And I know that this kind of leads into that comment that I know we were discussing beforehand, which is sort of expressing the frustration at the changes that CMHC, the government, have put forward. I can't read that, Gary, so go ahead and just tell us what
Yeah.
this commenter said.
This is from our most recent video that we posted last Monday, and Falgun Patel is really asking how many Canadians can afford a $1.5 million mortgage. And your example of that we just walked through helped explain some of that. And I think also, part of this conversation is, you're right, and they are right. There's not a lot of Canadians that can afford that type of mortgage. However, we're kind of talking about two specific markets, in this case, Vancouver, Toronto, and
Yes.
using the strategy that you just demonstrated. This will work. This will work right across Canada. And in fact, and you talked about, homeowners, perhaps, we'll call it, I don't want to use the word graduating, moving away from that 2-unit style home or buying a home that has the capability of 2 units. I can think of our own situation. We bought a new home this summer with a rather large walkout basement, and part of our future dream is being able to convert some of that into apartment where my son, who's going to be living with us indefinitely because of his needs, we can make apartment right into this
There
home
you go.
based on what
Yep.
we just kind of talked about, knowing that, hey, every family has different dynamics, every family has different needs, and being able to use what you have available is really, really important, and be able to, foresee what you're going to need and buying the right type of home or in the right area, that type of thing, right?
Yeah, and I think what you're talking about there is planning to house your children for beyond age 18 or beyond age 25 in many cases, right? And that sounds novel in North America, but it is not uncommon in probably 80% of the other countries that are outside of North America, right? Or regular standard Western civilization. I went to Italy a couple of years ago, and I'm looking at these tiny little apartments, and our tour guide would say, yeah, there's 3 generations living in that apartment. And it shocked me because of my background, right? How in regards to housing and things. But no, it's very common. It's very common in European countries, Asian countries, for people to live in a relatively small space as well, and live for, up until age of marriage, which, as we've discussed, can be a little bit later now for many people, into their 30s.
Yeah.
But yeah, look, to answer that question as well, and understanding the frustration, which is the underlying question is, that's great. The government's made amortizations 30 years and the ability to put less than 20% down all the way up to 1.5 million. Okay, that's great. But how the hell can we qualify for this thing, right? And I understand that. I understand that frustration. But let's talk about sort of big picture. What are the options right now that the government has been toying with before they reach this decision, right? So one option, Gary, was, and this is widely leaked, it's probably one of the worst kept secrets, the idea of imposing some kind of a tax on principal residences, right? And so this was one option, which when the public became aware of it, there was a huge uproar, right? Because people didn't want to effectively give the wealth from their home in the form of tax, which supposedly in turn would help the younger generation buy. So that was one option, okay? The other option is just figuring out a way to reduce the values of home, to bring down the values of home to meet current wage levels, okay? And again, if you talk to a 65-year-old about the betterment of the future of younger people than them, and the solution to that being dropping the value of your $2 million home in some way over time to 1.5 million, I can tell you not many 65-year-olds are going to be happy with that idea, okay?
Yeah.
And so is the solution that they've put forward the right solution? Probably not, okay? But having looked at the other options available to them and seeing the public outlash at that, then this is the best that they could do, especially going into a year in which we're likely going to have an election, right? So let's call this what it is. It is a campaign play in the midst of some turmoil in the Canadian governments. But the sad truth is it's made it easier for people who are already wealthy or from families who are already planning to help their children. That's what this change has made. It just made it easier for that demographic in society to grow their wealth, which again is part of the frustration for many people, because it used to be a level playing field and that everybody could make it, but this isn't assisting with that issue, really.
Yeah. Okay, let's move on, because there's been things happening perhaps south of the border that maybe we should talk about, the Fed cuts or the Fed cuts, the Fed rate cut.
Yes, maybe correct.
Anyway, so lead us into there. I can share my screen here in just a second here, and we'll talk about what's going on.
So guys, last week, the U.S. Federal Reserve cut rates by 0.5%, okay? Prior to that, us and the Bank of Canada had cut rates by 0.253 times. So they cut 75 basis points, but over 3 separate meetings, okay? And they're what you would call your regular rate cut. But the Fed, as you can see in this picture here, the Fed did what they would refer to as a jumbo rate cut, which was a full 0.5%. That's a 50 basis point drop in one meeting. And so a couple of things around that. So why did they do that? Why did they do that in the United States? And it's because of much weaker job growth and inflation coming down or very close to their target of 2%. So with that in mind, the governor of the Fed down there said, okay, we can cut the rate by 0.5%. So that's a jumbo rate drop. Now, what this image is sort of suggesting is, okay, because Big Brother, the United States, has been able to do this, it now allows Canada to potentially do the same, meaning that, at our next meeting in October, end of October, there's the potential that they could go ahead and match that, right? I will also tell you that there's probably a big sense of relief in the government, in the Bank of Canada, because we had moved 0.75% before the Fed did anything. And when that happens, there's always a little bit of a concern as to how that will impact, in particular, international trade. So put simply, guys, when we increase interest rates, sorry, when we drop interest rates before the United States, the Canadian dollar drops in value. When that happens, it makes our exports more attractive, but it also makes our imports more expensive. And the fact is, I think if you look at import-export data, we are likely importing more from the States than we are exporting to the States. And if this was to continue, then it would lead back to this little thing called inflation, which is the whole reason we were in this place in the first place. So this drop in the United States will give Canada that breathing room to say, oh, thank goodness, we were kind of playing chicken here for a while. And now we've got a little bit of a break where we know that, okay, the Fed is now agreeing that they're also stepping down. So we can sort of step down along with them. So I would say to you all, watch what's happening in Canada. October 25th, I believe, is the next meeting. And the sense is it's going to be at least 0.25%, but it could be 0.5%.
That, and I don't think it should ever come as a surprise to what whether it's 25 basis points, 50 basis points. Just look at some of these leading indicators, right? And we've been told to expect rate drops over the next several months. And this kind of leads into what we kind of promised off at the top of the call, where there's some lenders kind of elbowing each other out of the way. But before we do that, let's kind of set this up with the 5-year bond yield. Yeah. Let me just get rid of this here, and then walk us through what we're looking at on screen here. Let me just make this a little bit bigger, Dion.
Yeah, you can zoom in there.
But really what we're looking at, my friends, is the 5-year bond rate. And we're looking at it. Let me just change this to the 6 months so we can kind of see, what's been going on. And that downward trend is what's been going on. Currently, we're at 2.75. Why is that relevant to us?
Right. So just for context, guys, just within the last year, we were at 4% on the 5-year bond yield. Okay. And when we hit 4%, the retail rate at which you could borrow 5-year mortgage money was in excess of 6%. Okay. So now that the bond yield has dropped to this point, what's happening at the retail mortgage level is interest rates are now well and truly, down from 6.5% several months ago to somewhere in the 4% range, low fours, depending on the term you take and the product you take. So long story short, a drop in the bond yield is a drop in particular, fixed interest rates. And so we're seeing rates now in the last week or so that we haven't seen in probably close to 2 years, Gary. We're getting clients in at 3 years at 4.29, for example, whereas just a couple of months ago, a 3-year rate was definitely at the 5.5% plus rate. So the movements that are happening globally and locally are impacting this 5-year bond yield, which are in turn impacting fixed interest rates.
And with that said, Dion, so we're seeing some rate reductions in that scope. What are lenders doing to entice people to come? I know you've got some renewals that are coming in, or we all have renewals that are coming in. Should we be signing those renewals? What should we be doing?
Yeah, so I'll give you an example. I have a client who was with a major bank, spoke to him last week. The rate they offered him was 5.19. Decent rate, okay. But when I looked at what was available in the market, we had that 4.29 rate that was nearly, 1% lower than what he was offered. And so right now, it's the time to shop around. Like, it's always the time to shop around. Like, when you are renewing, never just sign. We've said this before, never just sign that piece of paper that you get sent in the mail, because almost always you will get a better rate, either from the same lender or from a different lender. But what I can say right now is the competition is so high that you'd be crazy to sign a renewal document right now without questioning the rate that they're offering you, because things are moving so fast that they might have offered you the best rate when they mailed that letter to you 10 days ago. But today, in the 10 days that have passed, so much has happened that better rates may be available, and oftentimes they're with different lenders. And other lenders are giving incentive to move in the form of things such as cashbacks, as well as some other cost coverages. So we've got clients not only getting better rates, but actually closing on their mortgage and actually getting money dropped into their bank account to the tune of 1,000 to 3,000, maybe even more, depending on the size of the mortgage.
Excellent. Excellent. And this is kind of what we've been I shouldn't say gearing up for, but gearing up for over the last couple of years. We knew that this would come to play, and it's now we're seeing the early stages of, lenders pushing each other out of the way because they hadn't been writing as much business as they had been over the last several years, in the last 12 months per se. And
Correct. Yeah.
they're looking to garner and to attract that business, just like any other business owner, right? Every company's out there
Correct.
in business for a reason, and has to earn and make a profit. Of course, we know banks are making lots of profit, but we won't go down that rabbit hole today. What?
Yeah.
What?
Well, let me
What?
just touch on that real quick, Gary, in that the banks, okay, the big other headline that came out this last week is we actually hit 2% inflation in Canada,
Yeah,
right?
that's right.
Which is the target rate, okay? And again, if you were to extract the cost of shelter, which has been driven by the interest rates, then people are saying actually close to around 1.5% in real inflation, right? And so the banks are smart enough to look beyond the media, the government headlines, and actually look to the raw data, which is, okay, we can see unemployment's down, retail spending's down. And so whereas a year ago, the banks couldn't see the future in terms of it being better than it is now, in terms of an environment in which lower interest rates could exist, they can definitely see that now based on just the raw economic data. So I think this is, again, why banks are feeling more confident to be a bit more aggressive with interest rates, because as rates drop, their margins will improve if they're getting clients in at today's rates at 4, which are very attractive compared to last year, right? But the banks are betting that maybe next year their margins will improve.
Excellent stuff as always, Dion. Remind us how people can get a hold of you.
Yeah, kangamortgage.ca or Instagram at the Dion Beg.
There you have it, my friends. That's Dion. We've changed this up. Now you're this way.
I'm over here. I'm right here.
There you go. That's the man. That's the man. Reach out to Dion, of course, with all your mortgage questions. I'm Gary McGowan. We'll see everybody in the next episode. Goodbye for now.